If you own gold or silver right now, you need to pay very close attention. The last 3 days delivered a rare combination of legal shockwaves and geopolitical tension that almost never collide at the same time. A major U.S. trade policy was struck down, only to be replaced within hours by a brand new tariff framework. At the same time, a ticking diplomatic deadline with Iran introduced the possibility of either a breakthrough deal or military escalation. Precious metals are standing directly in the middle of this storm. What looks like calming news on the surface may actually be fuel for a much larger move. The financial world runs on confidence, confidence in policy, confidence in leadership, confidence that the rules today will still exist tomorrow. Over the past week, that confidence has taken two direct hits. First, the legal structure behind sweeping U.S. tariffs was invalidated by the highest court in the country. For over a year, global corporations, exporters, importers, and foreign governments reorganized trade flows around those tariffs. Contracts were signed. Supply chains were moved, prices were recalculated. Then suddenly, the legal justification disappeared. You would expect stability to follow a ruling like that. Instead, within hours, a new tariff structure was introduced under a different law, one with a strict time limit and uncertainty about congressional approval. In practical terms, tariffs did not vanish. They transformed. The numbers shifted slightly, but the bigger issue wasn't the percentage. It was unpredictability. Businesses cannot plan around temporary frameworks. Investors cannot hedge against policies that may expire in 150 days. Foreign governments cannot build trade strategy on legal ground that may shift again. And if that wasn't enough, the ruling potentially opens the door to massive refund claims for importers who paid under the previous tariff regime. If courts determine those payments were unlawful, the U.S. Treasury could face tens of billions in reimbursements, at a time when annual deficits already exceed historic norms. Now layer in the second issue. A diplomatic countdown has been placed on negotiations with Iran, a limited window for agreement, a deadline with implied consequences, military assets positioned in the region, diplomatic statements hinting at progress, but without verified confirmation. The market now faces two parallel uncertainties: trade policy instability with legal battles ahead, geopolitical tension with unpredictable outcomes. When investors cannot measure risk, they move toward assets that exist outside political systems. Assets not dependent on executive orders, court rulings, or international treaties. That is the core problem. Uncertainty is no longer episodic. It is structural, and structural uncertainty changes capital flows. Now, here's where it gets interesting. Over the weekend, a headline surfaced suggesting that progress had been made in nuclear negotiations. On the surface, it sounded calming, optimistic, almost like a resolution might be near. But markets were closed when that story broke. Timing matters. When news capable of moving gold and silver prices appears during closed trading hours, it raises a critical question. Who benefits from that timing? A headline implying reduced conflict risk can soften the fear premium embedded in precious metals. That can create a temporary dip, the kind of dip large institutions often use to build positions. And here's what most people don't do. They read the sourcing. In this case, the information originated from regional media citing unnamed diplomatic voices. Not an official signed agreement, not a joint statement, not a verified policy document, just signals. Signals interpreted as progress. Markets often react to signals long before substance exists. Now combine that with the tariff issue. Even if geopolitical tensions ease temporarily, the trade uncertainty does not disappear. Even if a deal is signed, fiscal pressures remain. Even if rhetoric softens, structural deficits continue expanding. So here's the tension: short-term calm versus long-term instability. If negotiations collapse, metals could spike sharply. If negotiations succeed, metals might dip briefly. If negotiations drag on with no clear resolution, metals may grind steadily higher. Which scenario is most likely? History suggests prolonged ambiguity is more common than dramatic resolution, and ambiguity keeps uncertainty embedded in asset pricing. So the real question isn't whether gold or silver move next week. The real question is whether the global environment is becoming more predictable or less predictable. And if your honest answer is less predictable, then the implications become clear. To truly understand what is unfolding right now, you have to zoom out. Because what we're witnessing is not just a reaction to one headline, one court ruling, or one diplomatic statement. It is the collision of structural forces that have been building quietly for years. And when they're now surfacing at the same time. Let's start with the foundation: fiscal reality. The United States, like many developed nations, is operating under sustained and expanding deficits. This is no longer emergency spending tied to a crisis. It is baseline budgeting. Trillions are added to national debt annually, and the cost of servicing that debt rises as interest rates remain structurally higher than the previous decade. When borrowing costs increase while debt expands, something eventually has to adjust. Governments can raise taxes, cut spending, inflate away obligations, or continue borrowing. Historically, the path of least resistance has been currency dilution and further debt issuance. Gold thrives in that environment, not because of fear headlines, but because of long-term monetary math. Now add trade instability. For over a year, global trade operated under a defined tariff regime. Companies adapted, supply chains shifted, contracts were renegotiated. Whether those tariffs were good or bad economically is not the point. The point is, they were predictable. Businesses can survive high costs if they know those costs are stable. When the legal foundation behind those tariffs was suddenly invalidated, predictability vanished. But instead of clarity replacing it, a new framework emerged almost immediately, one with a limited lifespan and political uncertainty attached. That shift matters more than the percentages themselves. A temporary tariff system creates hesitation. Corporations delay investment decisions. International partners question long-term agreements. Capital expenditure slows. Markets do not panic in these situations. They grind. They hesitate. They reprice risk slowly. And when institutions hesitate, capital looks for stability. Gold offers stability because it exists outside policy. It does not depend on executive authority. It does not require legislative approval. It does not expire in 150 days. Now consider the geopolitical layer. Diplomatic deadlines tied to nuclear negotiations introduce binary possibilities. Either progress occurs or escalation follows. But markets rarely wait for confirmed outcomes. They price probabilities in advance. Military assets positioned in strategic regions increase perceived risk, even if conflict never materializes. Insurance premiums for shipping adjust. Energy markets build in supply risk. Defense stocks rise. Safe haven assets gain incremental bids. Even rumors, especially those released during closed market hours, can shift positioning. When headlines suggest diplomatic progress without official confirmation, they can temporarily suppress the geopolitical premium, embedded in gold and silver. But unless verified agreements follow, those effects are often short-lived, because structural risk remains. Now layer in central bank behavior. For multiple consecutive years, central banks globally have increased gold reserves at a pace not seen in decades. This is not emotional buying. It is strategic diversification away from overexposure to single currency systems. When sovereign institutions allocate consistently toward physical gold, they signal long-term hedging against systemic volatility. Silver operates differently, but in this environment, its dual nature becomes powerful. Silver is both a monetary metal and an industrial input. It benefits from the same safe haven flows as gold during uncertainty, but it also benefits from structural industrial demand growth in renewable energy infrastructure, advanced electronics, medical technology, and defense systems. At the same time, global silver supply growth has not matched rising industrial demand. Mining output expansion is slow. Refining capacity has limits. When investment demand intersects with industrial tightness, price sensitivity increases sharply. This is why silver often moves more aggressively than gold once momentum builds. Now step back again. What makes this moment unusual is not any single catalyst. It is simultaneity, fiscal stress, legal instability in trade policy, geopolitical deadlines, strategic military positioning, central bank diversification. Required. No panic headlines necessary. Just incremental portfolio rebalancing toward assets perceived as politically neutral and structurally finite. Gold and silver fit that description. But here's the nuance. Markets rarely move in straight lines. They breathe, they correct, they consolidate. A diplomatic breakthrough could create a pullback. A temporary trade stabilization could ease volatility. But unless the broader fiscal trajectory reverses, which appears unlikely, the long-term thesis remains intact. What we are observing now resembles a staircase pattern rather than a spike. Up, pause, up, pause. Each pause invites skepticism. Each move higher forces reconsideration. And the reason is simple. Uncertainty has shifted from event-driven to systemic. Event-driven uncertainty fades once resolved. Systemic uncertainty lingers because it reflects deeper structural tension. When executive authority and judicial authority clash publicly over economic policy, global observers take note. When diplomatic negotiations occur under visible military buildup, investors price caution. When deficit expansion continues, regardless of economic cycle, monetary credibility gradually erodes. None of these alone guarantee explosive metal prices, but together they form a reinforcing environment. And here is perhaps the most important psychological element. Confidence is fragile. It builds slowly over years and weakens gradually, until suddenly it doesn't. Gold tends to move when confidence transitions from assumed to questioned. Silver tends to accelerate when both monetary uncertainty and industrial constraint align. Right now, both dynamics are present. We are not watching panic buying. We are watching strategic positioning. That distinction matters because panic rallies often reverse quickly. Strategic reallocations tend to persist, Over the coming weeks, volatility is likely. Headlines will compete for attention. Analysts will argue over probabilities. Short-term traders will chase momentum. But beneath that noise, the structural forces remain. Debt expansion. Policy unpredictability, geopolitical friction, finite tangible supply. When those forces converge, tangible assets gain relative appeal, not as speculation, but as balance. And that is the deeper story unfolding right now. Not a single ruling, not a single deadline, but a convergence. A convergence that rarely happens quietly, and almost never without consequence. So what does all of this actually mean for gold and silver? It means we are no longer in a headline-driven market. We are in a structural transition. The court decision on tariffs did not eliminate trade tension. It complicated it. The executive response did not restore certainty. It introduced expiration timelines and new legal questions. The diplomatic deadline with Iran did not guarantee peace or conflict. It layered probability on top of existing instability. And markets price probability. Right now, precious metals are not reacting to fear alone. They are reacting to compounding uncertainty. There's a difference. Fear produces spikes. Compounding uncertainty produces sustained repricing. Let's break it down clearly. Scenario 1. A diplomatic breakthrough occurs. A formal agreement is signed. Military posture softens. In that environment, the geopolitical premium inside gold likely compresses. You could see a short-term pullback, perhaps sharp, perhaps brief. Silver might dip even more due to its higher volatility. But here's the key. A deal with Iran does not solve trade instability. It does not erase deficits. It does not refill fiscal gaps. Any dip created by easing tensions would be layered on top of unresolved structural issues. Scenario 2. Negotiations collapse and escalation follows. Even limited strikes would rapidly reprice geopolitical risk. Gold historically responds aggressively to military conflict involving major powers. Oil would likely spike. Safe haven flows would accelerate. Silver would follow, though with wider swings. This scenario creates explosive upside, but it comes with real-world consequences nobody should root for lightly. Scenario 3, no deal, no war, just extended tension. Deadlines shift, talks continue. Military assets remain positioned as leverage. This is the slow burn outcome. And ironically, it may be the most supportive for metals over the medium term. Why? Because uncertainty remains embedded. There is no resolution to remove the premium. Now add the tariff timeline. The newly implemented trade framework carries expiration mechanics. That means markets will revisit the issue repeatedly. As deadlines approach, volatility resurfaces. Investors dislike rolling uncertainty. Each new legal or congressional development forces recalibration. Meanwhile, potential refund obligations tied to the previous tariff structure introduce fiscal strain. If large reimbursements are required, they must be funded, either through borrowing or reallocation. Neither option strengthens long-term monetary confidence. And that's the core of the reveal. This is not about whether gold moves $50 next week. It's about whether institutional confidence in long-term stability is strengthening or weakening. When executive authority is challenged in court over trade, when trade policy changes form instead of disappearing, when military leverage frames diplomatic negotiation, when deficits expand regardless of economic cycle, that combination erodes predictability. And predictability is what fiat systems depend on. Gold does not depend on predictability. Silver does not require legislative stability. Their value proposition strengthens when systemic clarity weakens. That's why we're not seeing panic buying. We're seeing methodical repricing, higher lows, sustained bids, compression in gold-silver ratios. Those are signals of positioning, not hysteria. Could there be pullbacks? Absolutely. Markets breathe. But pullbacks inside structural uptrends often represent recalibration, not reversal. The deeper message here is simple. Even if one risk resolves, the others remain. And when risks stack faster than they unwind, tangible assets gain relative strength. That is the environment we're entering. Not chaos, not collapse, but sustained complexity. And sustained complexity is fertile ground for precious metals. Now I want to hear from you. Out of the three possible outcomes, diplomatic agreement, military escalation, or prolonged tension, which one do you believe is most likely? And more importantly, which one do you think markets are underestimating right now? Do you believe trade instability poses a bigger long-term threat than geopolitical conflict? Or do you think the Iran situation carries more immediate weight for precious metals? If you're currently holding gold or silver, are you positioned for short-term volatility, or are you thinking 5 to 10 years ahead? There's a big difference between trading headlines and building protection against structural shifts. And if you're not holding any exposure yet, what's holding you back? Is it price? Is it timing? Or is it uncertainty about whether this move has already gone too far? Drop your perspective below. Strong markets are built on diverse opinions, and the smartest investors constantly challenge their own assumptions. I read the comments because understanding how others see risk often reveals blind spots in our own thinking. If this breakdown helped you connect the dots between trade policy, geopolitics, and metals, share it with someone who follows markets but may not be looking at the full picture. The next few weeks could be volatile, and informed positioning always beats emotional reaction. Here's what you need to remember. This market is not driven by one headline. It is driven by a convergence of pressures. Trade policy that shifts form instead of disappearing. Geopolitical tension that introduces probabilities rather than certainties. Fiscal deficits that expand faster than economic growth. Central banks diversifying reserves toward tangible assets. Each factor alone might produce temporary volatility. Together, they shape a structural environment where uncertainty persists. And persistent uncertainty favors assets that exist outside political and legal risk. Gold does not depend on quarterly earnings or policy approval. Silver benefits from both monetary demand and industrial necessity. Neither asset requires institutional permission to retain value. Markets often move in steps rather than straight lines. Up, pause, pause. During pauses, skepticism grows. Headlines argue for reversal. Short-term traders exit.